Happy New Year, clients and friends of MBP Sterling Partners. It's Jamie, and I'm here to bring you our 2023 recap and 2024 market outlook. So without further ado, let's dig right into the slides. First of all, let's have a look back at the broad markets and indexes through 2023. It turns out that cash was not king. Even though we ended 2022 and started 2023 in a tough spot with cash finally showing some yield. We had lots of pundits say, just go to cash with your whole account and just leave it be. You'll get 5%. It'll be happy. That was not the case. That said, it is a good place for us to park and wait, and it is nice to be paid to wait on the sidelines when we need to or when we want to. But we did see finally some good returns after a painful 2022. Fixed income and equity alike were up on the year, but that was after some real chop during the year. So as you can see, the TSX was up and down throughout the year before finally rallying into the end of the year and providing us some decent returns. We were actually down at one point on the year in late October, but let's not look at 2023 alone. The returns were great, but we're calling it the year of the round trip because after a painful 2022, we want to look at those two-year returns. So as you can see along the right here, the two-year returns for the major indexes were not that hot. There are a couple of greens in here, but really when we go back to the previous high, 2023 was just a year of recovery from what we lost in 2022. Looking individually at the sectors in Toronto and in the US markets, there was a broad-based rally across the board. It was the interest rate sensitive areas like materials and utilities that did not participate, although they did come and try to make a run for it at the end of the year as interest rates really declined in October through December. We were talking earlier in the year about index concentration. That still exists, but we did see broad-based rallying in the US that saw the rest of the S&P 500 also contribute considerably to the returns of the index, even though those Microsoft, Apple, Nvidia, Amazon, Facebook, Google, and Tesla names were up considerably during the year. The rest of the rally, the rest of the index participated in the rally. You can see looking backwards, this is uncommon for a huge difference between the cap-weighted index that overweights those names and the equal-weighted index. 2023 was a standout year for that, and we ended with pretty huge concentration in those 7 names. In Canada, not so much. We saw a more even balance across sectors and across cap weightings. What about the bond side? Well, we saw rates flutter about during 2023, but finally decline as we went into Q4. As you can see, the junkier the bonds, the better the returns were in 2023. Those CCC bonds act more like equities than they do like bonds, and so the market liked them. But interest rates didn't start declining in earnest until November and December. And so we saw those more rate sensitive investment grade and AAA bonds really not participate in the rally till the end of the year. But that said, 2023 finally broke that 2-year down market for bonds. That's a very rare occurrence that we see 2 negative years for bonds in a row. Certainly hasn't happened in my career. We'd have to go back decades to find a similar outcome. The yield curves, the inversion is shrinking. So we measure on the 10-year 2-year and the 10-year 3-month yield curves in both Canada and the US. We're now 18 months into the point where the curves first inverted. Historically, yield curve inversions have precipitated recessions, and the lag between the first point of the inversion and the recession has gone between 16 and 22 months. So we're at 18 now. We're getting towards the long end of that scale. There aren't too many instances, so this isn't like a data set that we can particularly rely on, but we will say that it's too early to call it all in the clear. From a yield curve perspective, we could see some more time before that inverted yield curve ultimately lands in recession. We just don't know yet. On the bond yield side, as I said, we saw yields rise largely into Q3 of 2023 before they started to decline. And they started to decline because we started seeing better data from the inflation front, and we started to see our central banks ease their rate expectations. So as you can see here, in the Federal Reserve and the Bank of Canada, they have talked down their rate expectations, and the market has listened and reacted and lowered what they view their implied rates for various points during the year. So those top two charts for Canada and the US show the July mid-year implied overnight rate has declined to about 4.25. And that's on both sides of the border. And then the bars, the blue and red bars on the right, show us our market expectations for each central bank meeting between now and the end of 2024. So while we're at 5.25 in the US and 5% in Canada, both markets are expecting 5 25 basis point cuts over the course of the year. Now, it's important to point out that this is an expectation of the markets. The markets have gotten it wrong in the past, and we expect that they may get it wrong in the past again. They may get it wrong going forward again. But this is the market's current expectation, and we take that as a view of the existing sentiment. Why are we seeing central banks easing their talk on being hawkish with high rates? Well, in the bottom charts here, you can see CPI maybe finding a bottom. Now it's a little bit above the Fed and the Bank of Canada's target. They like to see 2% and lower, and we've stopped at about 3%. Time will tell whether that continues to decline or not. Employment is still robust, although as you can see with these dotted lines, Canadian unemployment rate has started to rise, so it looks like we've seen the bottom, whereas the US unemployment rate remains relatively flat. But those bars you see here are additional payrolls for every month as they're reported. And as you can see, the employment, even though it remains strong in both Canada and the US, the trend of strength has ceased and it seems to have flattened out here. So we're no longer seeing increasingly strong labor markets. So what about the recession that never came? Well, it's hard to go into a recession when fiscal spending is so high. The US and Canada have been running massive budget deficits and spending a lot of money. Part of this is due to COVID, but they've continued to spend as the COVID pandemic is in the rearview mirror. What you're seeing on the left here, each of these bars represents 1/4 of budget surplus or deficit. Most of these bars point down, meaning that they were in deficit. And the orange lines show the long-term 40-quarter, 10-year moving average of budget spending. And you can see that increasingly, governments are opting to spend more than they take in. So the budget deficits have been increasing steadily over time. It's hard to go into recession when governments are spending so much. You'll remember from Economics 101 that government spending is a direct input to GDP. And while we see this much spending, the other factors of GDP would need to be equally weak, if not more weak, for a recession to ultimately ensue. Another reason is the long and variable lags of interest rates. So we've got 3 examples here to show those long lags. So we've seen a lot of rate hiking in Canada and the US, effectively from 0 all the way to 5 and 5.25%. But there's been very long lags through to consumers. Remember, in Canada, mortgages have 5-year rollover cycles. So renewing your mortgage largely comes every 5 years. And so far, we have only seen 12% of Canada's mortgages renew by the end of 2023. So those who had 2018 vintages and had rates that were in the low 3s, that's where mortgage rates were in 2018, have had to renew into an environment where they're paying probably mid to high 5s, if not 6% mortgages. So that's painful, but it's still a relatively small amount of mortgages. In 2024, we're expecting even less mortgages. This data comes from Veritas Research, who's done the work on looking into the bank's balance sheets, but only about 10% of mortgages are expected to come due in 2024. So the bulk of these renewals happens in 25, 6, and 7, which incidentally are going to be the renewals off of the lowest rates. So those who got into mortgages in 2020 and 2021, they got the benefit of those very, very low rates. We saw 5 years as low as 1.5% and 1.6%. Provided rates stay as high as they are now, that's going to be shocking when those renew in 2025 and 2026. But we still have a couple of years to go before we see that. We see if rates will continue to be this high when they renew. And those who are in those mortgage are still enjoying low rates and therefore low payments. So this is an example of the long lag of interest rate hikes into the economy. In the US, we see a similar but different phenomenon. US mortgages are largely fixed for 30 years, so Americans can lock in those low rates for a very long period of time. They only have to give those up if they sell their house and move. So net new homeowners will have to get into a mortgage at whatever rate is prevailing. But if you have an existing house with an existing mortgage, you can hold on to that rate for a very long time, which creates even more lag on the consumer side between the transmission of those high rates to household balance sheets. On the corporate side, we see a similar phenomenon. It's not quite as stark as 30-year mortgages, but debt repayments for corporations, both investment grade and high yield corporations, they are largely concentrated in the 2026 to 2029 area. There was very little debt that came due, relatively speaking, in 2023, and little expected in 2024. So that transmission of higher rates can't really happen for corporations who sold bonds 2, 3, 4 years ago and do not have them mature for another 3 or 4 years going forward. Let's have a look at what the strategists around the street are forecasting for this year. On the interest rate side, there's a huge spread and almost no consensus of the direction of Treasury yields. You can see there's just as many who are predicting lower yields versus higher yields, and the spread between them is from 287 to 437 on the major strategists. This goes to show that there is very little consensus, and nobody knows where yields are going. On the equity side, we see a similar story. The estimates are all over the board. They're from -10 to +10%. We would point out that in 2023, the market actually ended up blowing away even the most bullish strategists' expectations with the returns that we saw in 2023. So we just show these as a monitor of current sentiment as opposed to where we actually think the markets are going for the year. We don't like to make one-year targets in any case. We're taking longer term views and investing with longer term time horizons. But this just does go to show you that the strategists really have no idea, certainly no consensus of an idea of where equities and bonds are going to be going. So what does that leave us for our outlook? Well, for bond yields, we still like them. They've dropped a lot since a few months ago, but despite that drop, bonds still look attractive on a historical basis. The proxy for yields in the bond market still is at near multi-decade highs. Again, they weren't as high as they were 3 months ago, but the entry point for bonds looks good given those high yields. In the US, the S&P 500, it's a little bit expensive. It's got a forward-looking price-earnings ratio of 22. If we take out that concentration of Magnificent Seven companies, that looks a little better. We get down into the very high teens, but still, that's a little bit expensive versus history. In the TSX, we don't see that phenomenon. There's no concentration. There's also a much cheaper market. So we're actually below our 10-year average price-earnings ratio in Canada, and the valuations on stocks look reasonably attractive in Canada as opposed to the US. Canadian dollar, our view here is to expect some weakness. The Canadian dollar gets a lot of its inputs from the yield differential between Canada and US bonds. As you can imagine, if US bonds are yielding more, people will favor the US dollar and earn that extra yield. So you can see that differential charted here against the level of the Canadian dollar. Crude oil prices also lend a lot towards the level of the loonie. When oil is strong, the loonie ends up being strong. What we've seen here is a little bit of divergence. The loonie has been stronger than the yield differential would suggest, and that's also come at a point where oil prices have been relatively weak. So this recent risk-on rally has pushed the Canadian dollar higher. Our view is to fade that rally. We expect the US dollar and other global currencies to be stronger against the CAD this year. What about the election? It could be a wild year. November 2024 brings us a US election. Our advice, at least from an investing standpoint, is you can ignore it. There's no correlation between whether there's a Republican or Democrat in the office and the stock returns for that year. It is good entertainment. It obviously has big implications for society, for global geopolitics, but it actually ends up having very little implications to equity markets. So we will see through these. We will take it for the important news cycle that it is, but we will ignore it as part of the investing cycle. So finally, looking at the market quilt over the past 15, 16 years, As you can see, it's very hard here to predict what is going to be the highest returning market year over year. These are in order of most recent returns, so 2023 highest to lowest. You can see the NASDAQ had a very robust return in 2023, but that comes off of a very bad return in 2022. So year to year, we can see some patterns in that most asset classes rise and fall together. But in terms of what is the leader and what is the laggard for each year, it's very hard to predict. So our advice for an unknowable future is always the same. One, we invest for the long term. We're not worried about any one particular year. Two, we invest in high quality companies and high quality securities and high quality managers. And three, we diversify amongst asset classes, sectors, and companies so that we can get more consistent results over multiple years. So that's it for our outlook for 2024. Thanks so much for joining me. We look forward to catching up soon. Hope everybody has a great day.